Chapter 1. Before any technique, we define the requirements of the system itself. If your method can't do these things, no amount of screen time will save it. 6 requirements. The system must move from a broad perspective to a narrow focus. It must see many time frames without ever switching charts. It must be descriptive, not normative. We describe the information price gives us instead of imposing rules on it. It draws on chaos theory, fractals, the butterfly effect, attractors and repellers, and statistical stability. And it reads price at 2 depths, intrinsic properties, what each candle says in absolute and relative terms, and extrinsic forces, location in the trend, overextension, barriers, and prior activity. Structurally, candles form price vectors, vectors form highs and lows, and those form broad price action. But the analysis flows in reverse. Fractal analysis into extrinsic forces into intrinsic properties. Context first, precision last. Chapter 2. Absolute intrinsic properties. Everything a single candle can tell you before you even look at its neighbors. Every candle carries 6 measurements. Bias or sentiment. Close above open is bullish, close below open is bearish. This qualifies the candle but doesn't quantify it. Body size quantifies it. The distance between open and close is conviction. Range, high to low, is the candle's volatility. Shadows are pressure. Upper shadows show selling pressure, lower shadows show buying pressure, and shadows power everything from dynamic frequency breakouts to fractal candles. Body percentage, how much of the range the body occupies, is your certainty gauge. High body percent means certainty, low means uncertainty. And finally, shadow symmetry and body position, the balance of the candle, which biases the uncertainty reading. Memorize the mapping. Bias qualifies, body quantifies, range is volatility, shadows are pressure, body percent is certainty, symmetry is balance. 2 ideas complete the absolute picture. First, body percentage as a spectrum. As the body shrinks relative to the range, certainty drains out of the candle. A 90% body is a statement. A 6% body is a question mark. Second, and this changes how you see every candle, candles are formed through the path of least resistance, open to the nearest extreme, to the opposite extreme, to the close. If the open is nearer to the low, price likely swept the low first before traveling to the high. A candle isn't a shape, it's a journey, and the shape is just the journey's footprint. Always interpret the 6 properties in context of one another, never in isolation. Chapter 3. 1 candle qualifies and quantifies, 2 candles tell a story. Relative intrinsic properties are where the narrative of price action begins. Bias change has exactly 3 modes. Continuation, a bullish candle followed by another bullish candle. The dominant player holds control. Reversal, bullish followed by bearish. Control switches hands. And disappearance, the next candle has no clear direction. Control dissolves. Every bias change is a statement about who is in charge of the market right now. That's the qualification layer. Next, we quantify the shift. Body size change is the power meter. Same bias with a growing body. The dominant player is gaining power. Same bias, shrinking body. They're losing power while still in control. That's often your earliest warning. Same bias, same body. Power is being sustained. Now flip the bias. If bias changes and the body grows, control switched hands, and the new player is stronger than the previous one. If bias changes but the body shrinks, power changed hands only for a brief moment. Bias tells you who. Body size change tells you whether their grip is tightening or slipping. Range dynamics is the evolution of adjacent candle extremes, and there are only 9 possible scenarios. Higher high plus higher low is an upward progression. An uptrend in the lower time frame. Lower high plus lower low. Downward progression, a lower time frame downtrend. Higher high plus lower low is an expansion, an expanding pivot below and rising volatility. Lower high plus higher low is a contraction, a lower time frame triangle, falling volatility. Then the flat variance. Upward expansion is support with upward leeway. Upward contraction is support with sellers pressing the highs down. Downward expansion is resistance with downward leeway. Downward contraction is resistance with buyers pricing the lows up. And flat plus flat, forward sustain, a sideways market. One warning: range dynamics can conflict with body percent and shadows. When they disagree, that conflict is itself information. Never read this table in isolation. 3 final relative reads. Shadow change. Growth in upper shadows is directly proportional to selling pressure. Growth in lower shadows to buying pressure. And unlike range dynamics, you track each side individually. Body percent change. An increase means uncertainty is draining out. A decrease means it's flooding in. Then the paradox: the more prominent an upward progression, the stronger the implied bearish power building against it. Strength and vulnerability grow together. And gaps. Explicit gaps are space between adjacent candle ranges. Implicit gaps hide within them. Counterintuitively, upward gaps feed bearish power and downward gaps feed bullish power. An implicit gap can plant bullish power between 2 bearish candles. Chapter 4. Extrinsic forces. The same candle with the same intrinsic properties means different things in different places. 4 forces modulate every reading: location in the trend, overextension, price barriers, and prior activity. Force 1. Location or trend phase. Where the candle sits in the trend, read through Dow theory, Elliott wave, and Wyckoff. Force 2. Overextension, divergences in velocity, acceleration, and volume. Built on the principle that the forces behind price action change before price does. Force 3. Price barriers, obstacles to the advancement of price. Where a barrier stands, reversal odds rise. Force 4. Prior activity, the current price movement itself. A bearish candle inside a decline reads as continuation or exhaustion. The exact same candle inside a rally reads as correction or reversal. And don't confuse the last two. Prior activity is the candle's place in the current movement. Trend phase is its place in the current trend. Location is read through 3 lenses. Dow theory: higher highs and higher lows define uptrends. Lower highs and lower lows define downtrends. Sideways bases are accumulation or distribution, and volume confirms price. When a new price extreme prints without a matching volume peak, the move is losing strength. Elliott wave: markets move in 5-3 wave patterns, giving you a roadmap for whether price is overpriced or underpriced, and how much leeway a trade has. And Wyckoff: springs and upthrusts after distribution. Manipulation events at the edges of trading ranges. Classic Wyckoff says they mark trend beginnings and ends. In reality, the pattern appears anywhere on the chart and at every scale. Use the simplest, most powerful part of each method. Depth is the enemy of breadth here. Overextension, Part 1, velocity. Velocity is the rate of change of price, and the RSI is our velocity oscillator. A reversal divergence prints when price makes lower lows, while the oscillator makes higher lows, bullish, or higher highs in price against lower highs in the oscillator, bearish. But the underrated signal is the continuation divergence, which fires in favor of the trend. Higher lows in price against lower lows in the oscillator is a bullish continuation. It times the end of a retracement instead of trying to predict a top. Going with an established trend is always easier than calling its death. Remember, when reversal and continuation signals alternate, the continuation side is stronger because it has the trend behind it. Velocity is the rate of change of price. Acceleration is the rate of change of velocity. Build it as an oscillator of the oscillator, the RSI of the RSI. It behaves exactly like velocity divergence. Only the source changes. And in the same way, velocity leads price, acceleration leads velocity. So a divergence between divergent signals is itself early evidence of change. 3 details govern the quality of any divergence. 1. Signal alternation: reversal and continuation signals alternate, and the continuation side always wins on strength. 2. Length between extremes: the wider apart the extremes, the stronger the signal. 3. Self-similarity: a fractal candle is literally a divergence in a lower time frame, weak on its own because its extremes are adjacent, but powerful when nested inside broader divergent signals. Volume is the third overextension source, on the principle that volume confirms price. With the histogram, compare price extremes against volume peaks. A fresh extreme on a weaker peak is an unconfirmed move. With cumulative volume delta, 4 patterns matter: buying exhaustion, higher highs in price, lower highs in CVD, The rally has no aggressive buying behind it. Selling exhaustion, lower lows in price, higher lows in CVD, the decline has run out of aggressive sellers. Bullish. Selling absorption, higher lows in price, while CVD makes lower lows. Heavy selling is being absorbed by passive buyers. Bullish. Buying absorption, lower highs in price against higher highs in CVD. Aggressive buying is being absorbed by sellers. Bearish. Exhaustion is a side running out of fuel. Absorption is a side being eaten alive. Price barriers get a full taxonomy because different barriers work for different reasons. By behavior, traditional barriers obey test, switch, retest mechanics. Containment barriers don't. They flag moments where price is overextended. By origin, geometric barriers come from the past geometry of price. Lines and channels, numerical barriers come from formulas. Bollinger Bands, moving averages. Fractal barriers merge both. The anchored VWAP and the linear regression channel are the flagship examples. By shape, horizontal, sloped, or dynamic. These classifications stack. An LRC is fractal and sloped, containment on its outer lines and traditional on its center line. And the core rule, combining barriers of different kinds, is what raises the odds you found a genuine market edge. A barrier is read in 3 acts. Before, is the approach sustainable, linear motion, energy exhausted and recovered in balance, or unsustainable, burning energy faster than it can reload? Unsustainable approaches make reversals imminent. At the barrier, watch the shadows for pressure, the intrinsic properties of the candles that touch it, the test-switch-retest dynamics, and where each candle lands relative to the line. The same candle means opposite things landing above versus below. A strong barrier reacts without being violated, and after, until price proves it's getting away, assume it's still testing. The cleanest escape evidence is a dynamic frequency breakout backed by context, which is exactly where this course goes next. Chapter 5. Fractal geometry is the appropriate mathematical treatment of price. This is where the method earns its name. The fractal dimension of price lives between 1 and 2. At 1, price behaves like a line. At 2, like a surface. Price is always more line than surface, but the closer to 1, the more predictable the motion. The coastline paradox explains the subjective element. A coastline's length depends on the size of your ruler. Pick a ruler and the measurement is objective, but the choice of ruler is subjective, and there are infinitely many valid rulers. In trading, your time frame is your ruler. Rough price action, intrinsic properties changing abruptly, is high dimension. Smooth action is low dimension. And here's the practical gift. Rough vectors on one time frame are smooth on a higher one, so fractal dimension tells you which time frame to trade. Hunt for slightly to very smooth. Side by side, the difference is unmistakable. On the left, high fractal dimension. Volatile, sideways, intrinsic properties, lurching candle to candle, connect its highs and lows, and the shape resembles a surface. Dynamic frequency breakouts fire constantly here, and they're one worse than the other. On the right, low fractal dimension, a line that bends. Properties evolve gradually, structure is legible, and signals fire clean. The same signal that is noise on the left is information on the right. Before you analyze anything else, classify the regime, because it sets the reliability of everything downstream. On any chart you can spot a smaller set of highs and lows, the minor flow, nested inside a larger set, the major flow. It's normal for both to run at once, and during retracements they oppose each other. A major uptrend pulling back shows a minor downtrend inside the pullback. The reversal signal you're waiting for is alignment. When the minor flow turns back up, and both flows point the same direction, price tends to reverse significantly in their favor. This one idea underlies half the entries in this method. Don't fight the retracement, time its death. Take the oldest idea in technical analysis, support and resistance, and pass it through fractal analysis, and you get frequencies. A frequency is the rate at which something repeats. Here, we treat candle highs and lows as broad extremes and look for the micro-scale level that captures the greatest number of candle shadows without violating a single candle body. With one candle, it's indistinguishable from a normal support line. With a series of candles, the frequency line reveals the exact level price is touching but failing to break at the highest possible rate. They can be horizontal or sloped. The principle is identical. This is how we get the precision of lower timeframes with the perspective of the home timeframe without ever switching charts. Chapter 6. Frequencies evolve as new candles print. And the way they break or hold gives this method its two signature signals: the dynamic frequency breakout and the dynamic frequency stop. Walk it with me on an upward vector. Place a line at the candle's low, its support for the next candle. Price makes a higher low, so the dynamic frequency advances to the new low. Then a candle tests the line without violating it. That's a dynamic frequency stop, a DFS, and the level is now stronger because it's been tested without breaking. A bearish candle prints and looks scary, but it respects the frequency. The line just filtered a fake out for you. Price touches the line again and takes off. Higher lows keep advancing the frequency until one candle closes through it. That is the dynamic frequency breakout, the DFB, and it signals reversal. In downward vectors, mirror everything. The lower frequency carries continuation, the upper frequency carries reversal. Compress it to a matrix. In an upward vector, a break of the upper frequency is continuation. A stop at the upper frequency is a pause. And a warning, because a DFS means the fractal dimension of price is rising, and a break of the lower frequency is the reversal. In a downward vector, mirror it. Lower frequency breaks continue the move, an upper frequency break reverses it. When you see DFB and DFS patterns firing together in smooth low-dimension price action, you have the strongest reversal evidence this method produces. But never trade them naked. Small price vectors degrade the quality of every frequency signal. Frequencies have a memory. The real-time frequency is the one forming in the current vector. Price reacts to it live. When a frequency breaks and a new vector launches the other way, the old vector's most prominent frequencies become historical frequencies, and the new vector reacts to them as it retraces. Even the exact levels where dynamic frequencies were broken or stopped keep working as reaction levels. This is the engine behind supply and demand zones. And all of it obeys the same test, switch, retest mechanics traders already know from support and resistance. Fractal geometry doesn't replace S and R, it sharpens it. More precision, zero lost perspective. Markets are chaotic systems, and chaotic systems have sensitive dependence on initial conditions. The butterfly effect. Small changes lead to large changes. We want to enter trades signaled by small changes, so the large change happens in our favor while we're already positioned. On the left, a reliable DFB, subtle, low volatility, close to the origin of the vector. The flap, the hurricane comes after, and we're in it. On the right, an unreliable DFB, confirmed far from the origin, with volatility already high. Enter there and the only direction the storm can go is calm. You get dragged behind the bus. Measure it objectively with ATR1, plotted as columns under modified Bollinger Bands. Reliable DFBs fire below the 2 sigma volatility level. And the smaller the vertical distance between the DFB and its DFS, the greater the butterfly effect. Chapter 7. Manipulation patterns. Throughout the history of technical analysis, there have really only been two: the trap and the raid. Fractal analysis lets you see both, at every scale. The bull trap. Buyers believe that if price clears a previous high, it will keep going. So buy stops pile up just above it. Large traders drive price through the level, absorb that demand, and enter short. The bear trap is the mirror image at prior lows. Wyckoff called these the spring and the upthrust after distribution and confined them to trend turns. In reality, they occur anywhere on the chart, at every scale. The raid is the other pattern. Large traders buy aggressively, small traders are recruited, and a positive feedback loop drives price higher with every nudge. A raid can set up a trap, drive positions into profit after one, or stand alone. And remember, not every fast move is manipulation. Context decides. Now shrink the logic to adjacent candles. A fractal bull trap. The current candle pierces the previous candle's high, but fails to close above it. A miniature bull trap, implying trap behavior in the lower time frame. The fractal bear trap mirrors it at the previous low. Sometimes the piercing repeats for 2 or 3 candles, double and triple fractal traps, meaning price is being pushed repeatedly into an area where large traders are absorbing everything. There's no isolated fractal raid, it's a one-candle pattern that only exists in combination. But hybrids are everywhere. A fractal bear trap followed by a bull raid followed by a bull trap. Two same-side signals usually mean reversal or a DFS. Mixed signals can go either way, and context decides. When a fractal manipulation occurs inside a broad manipulation, you have a self-similar manipulation, the pattern within the pattern. Here, the candle that springs the broad bear trap is itself a fractal bear trap. There are countless variations, and it's pointless to memorize them. Understand the elements instead. Two properties make these precious. First, every manipulation, broad, fractal, or self-similar, automatically generates a frequency line. Second, the butterfly bonus. A raid is a high volatility event on its own time frame, but when it lives inside a fractal pattern, it's a low to medium volatility candle in your home time frame. Exactly the volatility profile that makes signals reliable. Chapter 8. The fractal candle, the most information-dense single candle signal in this method. We'll identify it, classify it, grade it, and finally integrate it with everything you've learned so far. The rule is two conditions. If the current candle has a bullish bias, look at the lower shadow change. A bullish bias with a lower low than the previous candle is a bullish fractal candle, signaling a move up. If the current candle is bearish, look at the upper shadow change. Bearish bias with a higher high is a bearish fractal candle, signaling a move down. The previous candle's bias doesn't matter. Why does this work? Because it's a contradiction. The bias goes one way, while the shadows move the other. Sellers produced a lower low and found demand strong enough not only to flip the bias, but sometimes to print a higher high too. Sellers opened the door and found strong buyers on their way. Every fractal candle implies both a fractal manipulation and a divergence in the lower time frame. Context sorts fractal candles into two families. When the candle's signal disagrees with the prior price movement, a bullish fractal candle inside a decline, it's a reversal fractal candle. When it agrees, the same candle inside a rally, it's a continuation fractal candle. Then range dynamics grades their strength. A fractal candle printing as a downward progression carries a dissonance. Its lower half implies a bullish reversal divergence, while its upper half implies a bearish continuation, a weak candle. Print it as an expansion instead, and the dissonance disappears. That's a strong fractal candle. And an expansion fractal candle with a high body percentage implies a hybrid manipulation. The trap and raid already fired in the lower time frame, while your home time frame still shows low volatility. That's the butterfly effect, handed to you in one candle. When elements stack inside one fractal candle, you get the integrated fractal candle, the strongest signal this framework produces. 10 amplifiers. 1. Expanding range dynamics, sellers opened the door and buyers slammed it. 2. High body percentage, certainty. 3. The candle produces a DFB, with a DFS on the opposite side. 4. The butterfly effect, low to medium volatility at the signal. 5. Low fractal dimension, smooth surroundings. 6. Overextension, velocity, acceleration, or volume divergence behind it. 7. Final trend phase, after 3 or 5 clear waves. 8. Reaction to one or more barriers without penetration. The more barrier types, the better. 9. Embedded fractal manipulation. 10. Unsustainable motion leading into it. A candle doesn't need all 10 to be valid, but every element you add raises reliability and lowers frequency. Better opportunities are naturally rarer. That's not a flaw, that's the market being honest with you. Chapter 9. Chaotic systems move aperiodically, yet their distributions are stable. One tool captures that stability on a chart better than any other. The linear regression channel. The LRC assesses whether price is statistically overextended. It's a mathematical barrier, containment on the outer lines, traditional on the center line, and it's fractal and sloped by nature. 2 anchoring points. The left grounds on a prominent price extreme that makes sense in your analysis. The right grounds on a potentially newly formed extreme. That's the crucial difference from indicators like Bollinger Bands. The calculation window is grounded in places that mean something, not rolled blindly. Draw it when there's a warning, a DFB, a fractal candle reacting to a barrier, a manipulation, never on every candle. Default to 2 standard deviations, try 3 for extra insight, and use overthrow and underthrow duplication and frequency shifting, just as you would with pitchforks. Single vector or multi-vector, smaller LRCs confirming larger ones. That's the fractal use of the tool. Chapter 10. Why do techniques work at all, and why do they stop? To trade a tool with confidence, you must know where it comes from: behavioral, economic, mathematical, physical, or hybrid, and what that origin implies. 5 origins. Behavioral tools, chart patterns, support and resistance, work through the self-fulfilling prophecy effect. Crowds act on them, so they react. Economic tools describe the market economically. Mathematical tools, the LRC, fractal geometry, statistics, capture fundamental properties of price and owe nothing to crowd belief. Physical tools, the Andrews pitchfork, action-reaction lines, do the same from physics. Barely anyone uses them, so the prophecy effect is nearly absent, and they reveal geometry no one else sees. Hybrids blend classes, supply and demand zones merge economics with behavior. Frequency lines and fractal candles merge behavior with valid mathematics. The ideal trade combines the self-reinforcing crowd power of behavioral tools with the precision and timing of mathematical and physical ones. A self-fulfilling prophecy is a belief that comes true because people act as if it's true. The classic bank run. Crucially, it can only exist in a system that reacts to predictions about itself. The weather doesn't, that's first-order chaos. Markets do, second-order chaos, Soros's reflexivity. Perceptions alter the market, and the market alters perceptions endlessly. Now, prophecies come in 2 flavors: self-correcting, the sphere inside the bowl, and a tractor. One crowd reacts at a support, banks the small bounce thanks to risk aversion and hyperbolic discounting, and drives price right back. Techniques in isolation tend to be self-correcting, deceptively useless, self-reinforcing, the sphere balanced on the upturned bowl, a repeller. When several patterns intersect, several crowds act in unison for different reasons. The combined move convinces the market something real is happening, and the loop feeds itself. Integration is the key that turns self-fulfilling prophecies useful. Game theory gives trading its precise classification: a stochastic game of incomplete and asymmetric information with unknown and variable probabilities. Stochastic, outcomes are skill and chance at once. Incomplete, nobody knows every variable moving price. Asymmetric, players differ in data, tools, and sophistication. Unknown probability, you can measure a pattern's odds in the past, never the future. Variable, those odds drift as conditions change. Picture an arena of chess variants where moves in one game alter the boards of the others. You can play perfectly and lose, play badly and win. So there are right ways of losing and wrong ways of winning, and you must reward process, not outcome, because in a stochastic game, you cannot fully trust the system's feedback to learn from. And the deepest edge isn't practice volume, it's information, carried in your means of observation. Integration comes in 3 depths. Vertical, many techniques from a single method, volume analysis top to bottom. Horizontal, one technique from at least 2 methods, a channel plus a divergence. Hyperintegration, as many techniques from as many methods as you can genuinely handle at once. The trade-offs are honest. More integration means more reliability, but fewer trades. Better opportunities are naturally less frequent. It also means more difficulty, and the lower your time frame, the faster you must integrate, with time pressure pushing you toward biases and heuristics. And the ceiling. Integration raises odds. It guarantees nothing. A hyper-integrated trade cannot overcome players acting on a strong macroeconomic force. That's why integrated price action works best in relatively stable markets. Chapter 11. Knowledge without an operating procedure is trivia. 3 problems every method must solve: how to start the analysis, how to develop it, and when to trigger trades. Top-down, a broad extrinsic signal starts it, a phase red, a divergence, most often a barrier. You overlap the remaining extrinsic forces to build context, watch price against one or preferably several barriers at once, and only then descend into intrinsic properties, fractal candles, DFBs, before defining triggers, stop, and target leeway from phase analysis. Bottom-up inverts it. A DFB appears, a narrow, focused signal, then you zoom out to check whether the extrinsic forces support it, then narrow back down. Two rules bind both paths. Never start with intrinsic properties. A handful of candles holds too much information, and analysis paralysis follows. And if you can't integrate signals, either you can't see them yet, or they aren't there. And the absence of integration is the market telling you there is no trade. A trigger must be objective, precise, and well-timed. Market triggers are the simple kind. Context makes sense. A fractal candle or DFB closes, you enter at the open of the next candle. Stop beyond the newly formed potential extreme. Limit triggers exploit switch test retest mechanics. You place a limit order at the DFB line or a precise barrier and let price come back to fill you at the market edge. The payoff is dramatic. In the worked example, the market entry yields a 2.1 risk-reward, while the limit entry yields 5.11, 143% improvement on the same trade. The cost is equally real. Sometimes price never returns, and the trade leaves without you. Either way, a trigger is only valid inside a well-integrated context. You'll see fractal candles and DFBs everywhere. That is not an invitation to trade them everywhere. Chapter 12. You cannot control whether a trade wins. You can control exactly how much it can lose. Market analysis is probabilistic. Risk management is deterministic, and neither survives without the other. Two traders each make 10% on a trade. Trader A risked 1% of capital. Trader B risked 5. Same quantity of return, but A extracted 10 units of return per unit of risk against B's 2. A's return is 5 times higher quality. Now the confusing case. A makes 5% risking 1, B makes 10% risking 5. B's return is twice as large, and A's is still 2.5 times better. Burn this in. A higher return is not necessarily a better return. Sustainability comes from the quality of returns, and that's why risk management means minimizing risk while maximizing reward, never judging one without the other. Every risk-reward ratio has a break-even win rate, 1 divided by 1 plus R. At 1 to 4, you need 20% winners to break even, an 80% margin of error. Two mathematical truths follow. First, there's no free lunch. Open trades randomly, and your win rate converges to the minimum. Unfavorable ratios naturally produce high win rates, favorable ratios low ones. Ratios alone carry zero edge. Second, diminishing returns. As ratios increase linearly, the gain in margin of error decays exponentially. Moving from a quarter to 1 buys you 30 percentage points. The same distance again buys 13.6. So chasing the highest possible ratio is mathematically senseless. And judge every win rate against its ratio's break-even. A 35% win rate can beat a 70. What lifts win rate above break-even? Integration. Nothing else. 3 perspectives, 1 verdict. Technically, price action is about location and timing. Enter near reversal points with a strategic stop, and the math inverts. The far target becomes more likely than the near stop, and favorable ratios genuinely carry an edge. Ratio size is phase-dependent, smaller counter-trend, larger at the birth of a trend. Psychologically, loss aversion means losses hurt 1.5 to 2.5 times more than equivalent gains feel good. So rewards should run 1.5 to 2.5 times risk, just to feel neutral. Favorable ratios trade a manageable present discomfort for a sustainable future. Unfavorable ratios reinforce like an addiction, comfortable present, no future. Mathematically, always favorable, never unbounded. Put together, phase-dependent, favorably bounded. That's the whole prescription. Position sizing first. Risk 1% per trade, and it takes 100 consecutive losses to reach 0. Risk 10, and it takes 10. Sustainability is inversely proportional to percentage risk. So the real rule is, risk so little that you completely forget about risk, usually 1% or less, because fear taints analysis with what you want price to do. 3 sizing models. Linear risks, a share of initial capital. Safe, no compounding. Geometric risks, a share of current capital. compounds profits and losses, geolinear updates the percentage at predefined equity levels, and is the practical optimum. Then the yardstick. The goal of trading your own capital is to outperform your benchmark on a risk-adjusted basis in the long term, 36 monthly periods minimum. Risk here means the standard deviation of returns measured by Sharpe or Sortino. And the counterintuitive part, a lower return can be a better return if its Sharpe beats the benchmark. Drawdowns are unavoidable, consistency is not sustainability, and professional appraisal is nothing more than separating skill, chance, and risk tolerance. Trading has an addictive quality by construction. Uncertain outcomes raise dopamine, a bigger-than-anticipated reward spikes it further. The pernicious case is when a trader acts incorrectly and gets rewarded anyway. The brain reinforces the mistake, which is the exact mechanism of addiction. The counterweapon is to turn the machinery against itself, reward good behavior instead of outcomes, where good behavior means alignment with how markets actually work, an external standard. Use random intermittent reinforcement. Reward good behaviors at unpredictable times, in unpredictable magnitudes, so dopamine wires in discipline instead of recklessness. Accept losses as part of a stochastic game. Being a good loser is an edge. And note why hedge funds pay a salary plus bonus. Performance alone can't pay recurring bills. Trading income is for long-term wealth, not this month's rent. Context before candles. Never start the analysis at the intrinsic level. Integration is the edge. Isolated techniques self-correct into uselessness. Intersections self-reinforce into moves. Enter on the flap. Low volatility in, expansion after. Trade smooth, distrust rough. The market schedules the trades. You cannot trade whenever you feel like it. Waiting is the job. Deliberately weigh counter-evidence. An analysis without counterpoints is just a bias with charts. Keep ratios favorable, bounded and phase-sized. Reward process, not outcome. There are right ways of losing and wrong ways of winning. And once a trade is planned, obey the plan. Stop or target, nothing in between. Delayed gratification is the entire skill, in trade management and in the career itself. That's the complete fractal properties framework. Intrinsic properties give you the microscope. Extrinsic forces give you the telescope. Frequencies, fractal candles, and manipulations give you the trigger mechanism. And chaos theory tells you why all of it works, and why none of it is guaranteed. Trading price action correctly is frankly boring. Long stretches of waiting and analyzing, punctuated by the occasional pull of the trigger. Embrace that. The market will tell you when. Your only job is to be in front of the opportunity, framework loaded when it appears. Trade the process.